Jay, is the welcome screen on?
Yes, yes.
Music, that's why I was wondering.
Yes, then we can start.
Thank you. A very warm welcome, KCF members, to today's webinar. Hope all of you and your close ones are keeping safe and doing well during this difficult time the country is facing. The second wave has clearly hit us hard, and while the world seems to be on its way to a recovery, India now stares at another set of lockdowns, which could impact the economic green shoots we were seeing and hoping would turn into a full recovery. As an indicator to highlight that as of April end, India GST collections, as well as its market cap, were near all-time high, despite the COVID situation. To help us understand what's happening in the global economy and India, and also potential scenarios that can play out for the Indian economy and businesses, we have called upon a star speaker today from the investment industry, Mr. Ashutosh Bhargava. Mr. Ashutosh Bhargava had last addressed KCF members in a physical seminar on 9th August, which was titled The Art of Investing and Current Economic Situation at the SNDT Matunga. For the benefit of our members who joined KCF subsequently, I will briefly introduce Mr. Ashutosh Bhargava, while he needs no introduction. Mr. Ashutosh Bhargava is Head Equity Research and Fund Manager at Nippon Life Asset Management, formerly Reliance Mutual Fund. He manages 5 equity-oriented and asset allocation funds with a total AUM of around $2 billion. He has over 16 years of post-MBA work experience in investment research, and he has been working with Nippon India for the last 14 years. Prior to that, he started his career in 2005 with JP Morgan as a junior economist in their global macro team, where he was providing research support from Mumbai. He supported economic research for India as well as the European economies. Mr. Bhargava specializes in macro and rule-based investment strategies and has done his MBA in finance from NMIMS Mumbai. Mr. Bhargava also has a passion for writing. He has a blog on LinkedIn and has become very active on Twitter in the last 1 year as well, where he shares his macro views on the markets. He also shares his macro note called What We Are Tracking, which he started during the COVID times, which track the various recovery indicators since the onset of the pandemic. So without further ado, a very warm welcome, Ashutosh, on behalf of the KCF and its members, and would request you to address our members. Thank you.
Thank you, Karanji. Thanks for the introduction, and thank you everyone for taking the time out and having me for this discussion. So let me start with sharing my presentation. If anyone of you can confirm if it is visible.
Yes, it is visible.
Perfect. So, the environment is very uncertain. All of us understand that. But let me start with this particular slide. These are the headlines we had in March of 2020. Look at these headlines. The world is staring at the biggest depression since the Great Depression of 1929. Global financial crisis probably would look very small in front of the the COVID crisis that the world is staring at that point. And every big research house, investment bank, international agency were talking about that we are in for a very, very bad times, and asset markets were crashing. And just look what happened over the next 1 year. In the last 13 months, world markets, equity markets have doubled. Any market you look at have given almost 100% kind of return. Now, if you are giving a lot of importance to the headlines, which you are reading in different publications, you are watching CNBC, even talking to fund managers like us, no one would have told you that this is even a remote possibility. In fact, in the history of financial markets, I mean, we have seen a lot of crises, but we have never seen that from top to bottom and bottom to top. Market completely reverses and regains the previous high in a matter of 6 months. We had 35% kind of correction in US market, and which happened over the period of five odd weeks. But in the subsequent 5 months, market completely recovered. And this is the table I'm showing it to you, that there's no precedence of that. So at one hand, you had a mother of all black swan event called COVID. But the bigger surprise to me, was the kind of recovery that market saw after that. And that's what I call white crow. I mean, again, it's an unexpected event, but unlike the black swan, that the connotation is negative. And when we talk about white crow, it's equally surprising and unexpected, but the connotation is positive. So we recovered in the matter of 6 months. What about our market? India has also seen, although we have a limited history of our market, but India has also seen crisis. The last 40 years, these are the kind of crises we have seen, from Harshad Mehta's scam, which is now become very popular during COVID because of that web series. But there are other crises also, which has happened before that and mainly after that. Asian financial crisis, dot-com bubble bust, global financial crisis, and so on. Every crisis, whenever it has happened, it has taken many months to years for market to regain its previous peak. And what I'm showing it to you on the right-hand side of this slide is the return in terms of adjusting for inflation, because at the end of the day, what we are trying to see is that whatever purchasing power that asset class had, how many years it took for again go back to that same purchasing power. And generally it takes 13 years for markets to come back to, in the real terms, to come back to the older level. And again, this crisis was phenomenal. That while it's a huge human tragedy and huge economic cost, but in a matter of 10 months, we not only regained the previous highs of 12,500 on Nifty, we actually went further up by 20 odd percent versus the previous high. So this is outstanding. It is remarkable what has happened. But why has that happened? As all of us know, all in the hindsight, and hindsight is a great thing. It has happened because there's a saying in the market that we as an investor, we have to stop panicking when one thing happened, when policymakers panic. And in March 2020, when these kind of headlines were coming, these policymakers panicked and panicked really hard. And I'm saying policymakers, right from the government to central banks, everyone panicked. And what we saw in the subsequent months is something which was also unprecedented. So it's not that world is not familiar with Fed and ECB and RBI, these government and stimulus, but never ever in a matter of 1 year, you have seen this kind of money printing. So whatever money we have today in the world, 40% of that money has been created only in the last 13 months, post-COVID. The kind of policy support or liquidity injection these central banks have done, to put things in perspective, top 4 central banks have put in $1.25 billion every hour post the COVID crisis, post March till December last year. And they still put in a lot of money, close to $500 million every hour, even now as we speak. This is what has led to the white crow, which I'm talking about. So 2020 was a disastrous year, but with the help of these policymakers, what we are staring at is a great and very promising 2021 from the global perspective. And this is how markets have done. Extremely bad, horrific first quarter of calendar year 2020. But since then, it's almost all green. You name any asset class, I mean, it has surprised the most optimistic, most bullish person, bullish investors. And why it is happening, if you see these charts, we are not talking about bubbles, Bitcoin, and you look at anything and everything, commodities, agri-commodities are up 70%. So I think everything where, which ideally should have suffered with the kind of economic and so-called human crisis which we saw, got negated. In fact, got overcompensated by the kind of policy support we got from the governments and, more importantly, central banks. And this famous Buffett indicator of global market cap to GDP is at all-time high. Credit spreads are at all-time low. And I can give you so many examples of these things which all of us keep on reading. But the moot point is, what would you would have done logically, rationally in March 2020? March 2020, many advisors, I mean, including mutual fund managers or salespeople, would have told you that look, things are uncertain. This is a very weird crisis. We don't know any solution. Vaccines take years to come. Already global debt to GDP is high, so it's better to have a balance or maybe more safe kind of asset allocation. Now, anyone who would have listened to those kind of advice would have suffered badly. Last 12 months, what we have seen is the record divergence versus what we call as risk assets like equity versus the safe assets like fixed income. Fixed income market is in some kind of correction of bear market, whichever market you're looking at, whereas equity markets are boring. Never ever in the history of markets you have seen this kind of divergence between equity and debt. And it's not only equity and debt. You look at within commodities, like whenever there is a fear or of inflation or some crisis, people usually run into buying gold. I mean, what has happened to gold? It has underperformed copper by almost 100% in the same period. Uh, you have seen house prices going up by 20-25% at a time when labor market was weak, economies were. And in our market, I mean, small caps have outperformed large caps by 40%. I mean, who would have thought? And hand on the heart, I'm sure everyone who's there in this discussion, I don't think anyone would have thought that, or no one would have told you that it's even remotely possible. So where we are now, after, with this great hindsight benefit, um, one thing is very clear, that you either get good news or good price, and rarely you get both the things. And last year we had very, very bad news. But then with the kind of panic which policymakers showed, now you have a very good price, but you don't have bad news about the market. Markets are not collapsing. In fact, they are at a valuation which people are calling as a bubble territory. The way forward is going to be different from the last 12 months, because it's unlikely to be one way uptrend the way we saw in the last 12, 13 months. And a lot of good news is in the price, right from early, discoveries of vaccine, the availability of vaccine, to Trump being, who was a big nuisance, so to say, in the from the global trade perspective, is no more the U.S. president. So many good news. Whatever good could have happened have happened, and going forward. We are again we remain in as uncertain environment possibly as we were few months back, and a lot of the global markets and global economy fate would depend on the effectiveness of these vaccines and how effective these vaccines are, how long lasting the impact of these vaccines are, particularly for emerging markets like India, Brazil. We are in the very early stages of vaccination, so we need to see how fast we can ramp up. But all in all, it looks like, given the large economies like China, US, and even Europe, they are probably past that peak phase of COVID. And now, the COVID is not a big problem. The economies are reopening. You are going to see huge global growth, and to an extent that people are now worried about new things. Market has a tendency to worry about new things. Now they are worrying about inflation. Growth is not a worry at all. So to my mind, given that people are not getting worried, and complacency is high, I think this is a good time to start expecting volatility. I think, it's may not you may not have a reason where it will come from, but it will be there. I think next 12 months, 15 months would be far more volatile and very different from a one-way uptrend, massive uptrend you have seen in all risk assets. Now, I quickly come to Indian market and Indian macro. Few things are going right in India. Rural sector is generally doing well. The government and the RBI has been supportive, but to be very honest, the second wave has been disastrous. Probably it was not expected, and therefore the preparation going into the second wave was weak. We don't have a pan-India lockdown, but to be honest, it doesn't matter, because various local administrations are putting local lockdowns, and it's all some of the parts. When so many states and local administration put in these restrictions, there is an impact on activity, and this is what we are seeing right now. This quarter was supposed to be a roaring quarter in terms of YY growth, which is not happening at this point of time. So there's a possibility of economic growth, which was supposed to be in double digit, that not only get delayed, but there could be some growth downgrades possible. The good part is, despite that, I mean, one thing is very clear, is that vaccinations are happening. More than 9% of India's population have got at least one dose. The only data point we have to look at, is the case positivity rate, which is the number of cases which are coming every day on a pan-India basis versus the kind of number of tests which are happening. So right now, this ratio is at more than 20%. And last time in September, when we peaked, it was around 10, 11%. So that is something, while the number of tests are 17 lakhs today, these tests have to go to 25, 30 lakhs. And this test positivity rate, which has come down to below 10% in Mumbai, and on a pan-India basis has to come below 10%, then only you can expect some meaningful opening up of local restrictions. And, uh, a lot of these scientists and these scientific models from IITs and from different experts, their model suggests that maybe over the next fortnight, India will see the peak of cases. Maybe the cases are underreported, and in a perverse manner, there are more people which are infected than official data suggests. The only good part about this theory is that means, we are uh, closer to the peak than, otherwise what official data indicates, that only 2 crore people have been infected with COVID, which doesn't look right. So vaccination works. I'm not the first one to tell you this thing. I mean, it has been working for a lot of countries. Some country it's working like miracle, like Israel. But even in US or Europe, there is clear evidence that A, vaccinations work, and B, if not in terms of the number of cases, you can still get an infection, but the case fatality rate, severity of illness, I think that is definitely much lesser when more and more your population is vaccinated. So the only question, and I call it $1 trillion question, is that how long this vaccine immunity lasts? If it lasts 1.5, 2 years, then country like India, which is a vast country, it's a good news, because then you will be able to successfully vaccinate a lot of people, and hopefully over the next couple of months, the number of vaccines which are available will increase from 6, 7 crores in India to 12 crores or 14 crores. And I think where it's very important that this immunity lasts for 1.5 to 2 years, and I hope the efficacy is not as short as 6 months or 9 months. But otherwise, then it will become very difficult to come out of this loop very easily, and this whole story might get delayed. The other challenge that we face from the both from macro market perspective is that globally growth is very strong, and along with that, so much of liquidity is creating inflation in almost everything: house prices, now wages, commodities. It can lead to some kind of cost push inflation. I mean, if you look at last year corporate earnings, they have surprised positively. And the bigger story was not that, yes, second half was better than what was feared. We had a sudden decline in COVID cases, and reopening was better. But the other big story was cost cutting, and there was huge cost control, margin support, and that is missing as we move into FY22, because there is cost push inflation, and the producer price inflation would be more than 10%. So there is definitely going to be margin pressure. Unfortunately, this is all happening at a time when there is going to be some volume impact also. But if these scientists are right, and I have faith and hope, but obviously I can't say this thing with 100% conviction. Assuming these scientists are right, maybe this is the quarter where the disease will peak, and with more people getting infected, along with the vaccination ramping up over the next 4 to 6 weeks, you will definitely see reopening of the economy in the second half of this fiscal year. You again see a similar kind of jump, very similar picture like FY21. So that's the hope. Now, who's doing the heavy lifting in this country? I mean, households are under pressure, businesses are under pressure, government has their own constraints. Who's doing the heavy lifting? It's the RBI, and they are doing a tremendous job. And sometimes, it's thankless to kind of job, because they don't get enough credit of what they're doing. The interest rate, they have kept it low. The inflation tolerance is very high. They are providing liquidity that like there's no tomorrow. And they're not worried about what credit agencies have to say or external agencies have to say. And the power to the RBI is coming from the fact that India is sitting on huge forex, almost 15 months of imports worth of forex that we have, and that gives them a lot of confidence and power to support the government, do our own form of quantitative easing, and this is exactly what they are doing. Apart from that, they are also supporting the banking system, wherein they have eased the rule in terms of asset quality recognition, etc., so that the economy is not badly impacted. And hopefully this is a short-term phenomena, and we come out of it pretty soon with the RBI support. But RBI's role has been paramount in terms of avoiding the kind of crisis, economic crisis. So health crisis is definitely something where all of us can blame this and that, but economic crisis, I think we should give credit that the RBI has done a phenomenal job. But we need to understand that, COVID crisis was not a sudden shock. Obviously, it was a sudden shock, but not a lone shock which India had seen over the last 5-7 years. In fact, it was the fourth successive shock in 4 years. Before that, you had demonetization. GST was also some kind of shock to the unorganized sector. And then we again had our own shadow banking movement in the form of this NBFC crisis, ILNFS, and DHFL crisis, wherein the cost of capital for a lot of places had gone up. And therefore, we need to understand that this patient called India had seen some viral fever already, and it has been impacted with a very serious viral now, subsequently. So it's been probably the most prolonged period of economic slowdown, almost 3 years, and we have never seen this kind of situation. We have gone back by almost 2 years in terms of it will take at least 2 years for India to reach the same level where we were in FY20. So FY20 GDP hopefully be very similar to FY20. So I think 2 years of India's growth, India's employment, etc., has been lost because of this COVID crisis. But even before that, things were not very rosy. What was missing from the great India story? I mean, there's a great story, great demographic story is missing. And if I recall correct, when I came to the last to the similar discussion 18-24 months ago, when all of you had kindly invited me, and delighted to I was delighted to be there for the talk. That point also I said that don't think India's story is a entitlement and don't take it for granted. Everything will be great. What we are dealing with, and even before COVID, is a very different kind of problem, which is demand problem. India had supply side problems, infrastructure, and other supply side problems, but India never had a demand side problem. And what we are dealing with is the lack of demand. So no one clips about lack of power or lack of roads, lack of port availability. People talk about demand is missing. Where would the next source of demand would come from? How much government can support? I think two things are very important. The government has done their bit. They have cut indirect taxes, they have cut direct taxes. Raw material till very recently were becoming cheaper and cheaper. A lot of corrections in factors of productions have happened, but again, it will fall back to two important things. And this is my kind of summary of the Indian macro, and then I come to the market part and the real part, which I'm going to discuss about the importance of asset allocation. Is that this income shock, while I'm talking about FY22 second half being good, but if you need more sustainable recovery beyond FY22, you need few other engines to work. Particularly, you need the investment cycle to come back, and for that, you can't overly rely on government because they have their limitation in terms of resources. So private sector has to come back, and there the good news is that at least for few sectors, sunrise sectors, government has announced these production incentive schemes. These are sunrise sectors like electronics, pharma, chemicals, and that's where you will see both imports, substitution possibility, more capex coming in, both from the domestic investors as well as from the FDI. I think that is something where a lot of people have high hopes, including me. But two things have to work, to be honest, for the macro cycle to be sustainable. And we come out of this phase of bad growth and bad employment situation is that credit growth has to pick up and export engines has to fire. Credit growth in India is stuck at 50%, around 50% of GDP for the last 10 years. You had the banking problem, you had the balance sheet problem of the corporate, this scandal, that scandal. I think we've come a long way in terms of the improvement of banks' balance sheet and corporate balance sheet. But now we need more people to borrow, more banks. Banks should be willing to lend more. And that I think is very, very critical beyond FY22. Also very critical is that, as I said, global demand is great. And it's likely to be sustained because policymakers are providing full support. It's kind of war they have declared against, um, those who said that they can't generate growth or they can't generate inflation. And I think that kind of environment, exports should be and hopefully should be the engine of growth at the early stage of the recovery. Now, this is all the macro part, but as investors, as much we want to understand macro, appreciate macro, don't forget that these are two different things. When we say market and macro, they are two different things at two levels. I'll come to the valuation and liquidity part, but at the fundamental level, when we say market, we are concerned more about the earnings. And that's why I want to highlight that micro is looking far better than macro. Why do I say that? In the last 10 years, India has seen a massive down cycle. And in massive down cycle, what has happened is that a lot of sectors, number of players have come down. Competitive intensity has actually come down. And for some of the government initiatives like GST and DMON and all the other initiatives to have better compliance in the system means the companies in the organized sector are gaining market share. So I think this is a good news, and you have fewer companies. So even if the macro growth, the GDP growth is not 8-9% and stuck at 5-6%, you don't have as many companies, barring in few sectors like autos and maybe white goods, etc. But in a lot of other sectors like telecom, even financials, the competitive intensity has come down sharply, and that gives the pricing power, that gives the ability to the corporates to pass on the all kind of stresses and costs to the consumer. And I think this will happen. Second thing is very important to understand is that um, India, Indian market is not the right barometer for Indian economy. 50% of the earnings have nothing to do with India. And I'm not only talking about Nifty here, I'm talking about things even beyond Nifty. So there is a chart I'm showing it to you. Nifty, we are all aware, IT, pharma, you have auto export companies, or you have these commodities where we are the price takers. 50% of the earnings are linked to global demand and global pricing, and which is in great shape as we speak. But even beyond Nifty, if you look at the PAT composition, and this is still FY19 because after that you have this COVID shock, even then, domestic consumption and domestic investment and FSI, all these put together was only around 50%. And commodity and an export, even for the S&P 500 companies, if you exclude the Nifty company, for remaining 450 companies, almost 50% of the earnings can be explained by exports and the commodity which is pricing. So what you will see in a world where global demand is very strong and India is taking time to recover, earnings will be growing at a faster pace than the GDP growth. And in the last 10 years, it was just the other way around, where profit to GDP was coming down. Now you will see it will go up. Uh, and that's where, this macro, while it is really concerning and, it's very distressing to see the human tragedy around. And hopefully, this gets over very soon, but we need to be mindful that we are talking probably two different things. And if you look at valuations, don't forget, it's all same. The strength of the global capital market, global liquidity means that markets are up everywhere. Every commodity, every market is up. So part of this valuation story is to do with global liquidity. But if you look at India versus other emerging market, and you look at the historical valuation of India versus emerging market peers, we are actually below average as we speak. In fact, there has been some derating of India relative. Having said all that, there's a lot of positives that has also been priced in. I've never seen this kind of gap between the trailing P of our market and forward P, which is humongous, and it only reflects the kind of expectation people have with earnings over the next 2 years. Sum and substance of this market and macro outlook is that, this is our base case. And as I said, generally, we find difficult to forecast. This environment is extremely, extremely difficult. And I keep repeating, and I'm repeating for the first time, that 2020 has taught me that a great lesson in forecasting humility, and I hope it has taught the same new humility to a lot of other people. But keeping that aside, our base case is that global recovery will be strong and likely to continue, mainly because of the kind of policy support they're getting. Look at the kind of, for example, the earnings which are coming in, for tech majors, etc., in the US and Europe. Um, Hopefully, this surge in cases that we are seeing, and the same template what we have seen in US and Europe, they also had the second and third wave. This we also have a peak coming up very soon, and then with the improved vaccination, we should also this storm should also pass. In the second half of this financial year, you see the recovery. Valuations are very high. The only argument which people have to support valuation, and despite huge earnings, growth being in the price, is that look. I mean, what is the choice? Interest rates are low internationally, or as well as in India. I mean, equity is the only thing. I mean, you like it or not, relative valuations is what people are looking at. It has some merit, but then you can stretch it to that extent only. I mean, we are talking about very high valuation to start with at the beginning of the bull market. And every investor, I mean, I belong to one of the fund house, and I'm sure a lot of investors would concur with me that technology disruption is affecting a lot of sectors and causing a lot of difficulty in terms of choosing the right theme, choosing the right sector at the right valuation. So these challenges are there in real life, and it's there for everyone in every business. But as an investor, I think this is a big challenge. Um, and therefore, when we look at preferred theme, and we strongly believe that you have to get into the right themes. We think large banks have, from a long 5-10 year perspective, these are theme I want to talk about. Large banks have a good future. I think credit to GDP, as I said, is at 50%. And if you look at any market, it has, whenever they have matured, it has gone to 75-100%. So which banks, I don't know. I mean, there is a new age banks, a lot of tech angle, which is there. But hopefully the large banks would have the all kind of wherewithal to participate in that story. So that's one. I think in the short term, some domestic cyclical sectors like real estate or cement, they are showing a lot of resilience, and hopefully investor would look this soft period of second wave through, and um, that these sectors are unlikely to have any technological disruption, so they may also do well. Global cyclical sectors like tech or metals, I think from at least from the medium term perspective, look very good. There is a pricing power. There is demand supply equation which is in their favor. In a more structural basis, I think this theme of China plus one is a genuine theme. I think import substitution is a very genuine theme. Government, one can argue, is late or early, but at the right. I mean, to my mind, um, if you talk to the corporates are really excited to exploit that when corporate taxes are lower and this PLI schemes have come, and world is looking for alternatives to China. So I think this China plus one theme in electronics and pharma, chemicals, and it may keep expanding to other sectors. Is a good theme. There are 100 unicorns with more than $1 billion, which are unlisted, and these will get listed. I think that itself will create a lot of winners. Last but not the least, I want to highlight is that don't discard this whole theme of ESG. Trust me, bulk of the money you are seeing right now coming in global markets, emerging markets, as well as in India, are ESG compliant investors, and this is where the flow of funds are. So you need to find companies, I think, not the ESG per se, but every what we say that every saint has a past, right? Or every criminal has a future. So you need to find companies where ESG score, ESG ratings are improving, and they are improving their scores both on environment, social, and governance side. And I think this lesson has been very well understood by Indian corporate, that governance and be aware about the environment, etc., would only help them in terms of getting better market cap. So look for this team. Don't think it's a fad. I think it has a long future, long runway ahead of us. Now, with all this, again, the caveat is that, long term is always good. And Nehruji used to say, if you remove hope from this country, there's nothing left. So there is a lot of hope. We are, and only the optimists make money on the long side, and we are optimists. But we also understand that, while these things sound easy and There are always some logic and fancy logic behind these things. These things are very difficult to practice. Now, to start with, I'll just I want to highlight, that this is not the first time we are seeing the crisis. We have seen in the last decade also, 2013, 2018. Every time there's a crisis, there's a recovery. The recovery generally very sharp. The long-term market has done great, double-digit CAGR return. It's all look good, right? In the hindsight, that India has done well, not because of politicians and the leaders, but despite them. And that story is there. I mean, it's not only India. If we look at the US market also, it's the same story. It's a far longer history that there has been crisis from world wars to this crisis, that crisis. And human innovations have always trumped all kinds of fear and crisis, and markets have delivered what they have delivered, multifold returns. Uh, but then it's a long-term story, and long-term can be, as John Bernard King used to say, long-term everyone is dead, right? So let's break it up in the short term. This is what it looks like when you break the market in the short term. So this is US market, this is Indian market. Do you find a pattern here? I don't find any great pattern. The way that I found the pattern in a multi-decade upturns, that it only goes up. When you break the market on an annual return basis, it's all over the place. Yes, there is a positive bias, but there are many periods where there's no return to negative return. So randomness increases when you break the period, and the long term is nothing but some of the part of short term. If you further break the period into months, not into years, this is the data 18, 20 years of data of Sensex. What it tells us, you won't find a lot of pattern here. I mean, last 18, 20 years, there has been 40% of the time where BSE Sensex, the Sensex has delivered negative returns. Possible. I mean, within that 40% stance, 43% of the time, market is delivered negative 5% or more, negative returns. So, fat tails are far fatter when you break the period into the shorter periods, and there's a lot of randomness, noise around the short term. Now, even if you know that, look, this year was great, or that this year was bad, is there a pattern for the next year returns? You look at US market, you look at Indian market. Actually, there's no pattern. If you know the returns of this year, can you say what could be the return of next year or so? The answer is no. Yes, if you had a really bad year, like 50-60%, typically there is always a bounce back because the policy response is also sharp. But then if you look at this chart, what I'm showing it to you here is that the lower bars are the average return for Dow and Sensex in the following year when you had this kind of return. The pattern is not very clear. So while market is positively biased, upward looking, there is no pattern as such. If you break the market into months and quarters and years, even in terms of themes, it's not that market. Not only market is difficult to on its own as an asset class, but within the market, the leaders and the losers keep changing. I mean, I'm just showing it to you what has happened in the market in the last 25 years. The leadership has continuously changed, and COVID will probably also do that. I mean, what you are seeing is probably the leadership in commodity stocks and some bit of newest technology stocks, which are getting benefit of the COVID crisis. I mean, leadership changes every time, and that is the only thing constant. And every 3-4 years, you have a new set of leaders. Now, it's easier, in the hindsight, everything is great, but it's very difficult to ascertain what would be that leader leading asset class. So I'm just showing it to you, asset class performance in the last 15, 16 years between three asset classes: equity, debt, and gold. And these are three asset classes everyone is familiar with. And if you see, there are periods when equities have outperformed gold. There are periods where gold has outperformed both equity and debt, and there are periods when both equity and gold has underperformed fixed income for a substantial period. So the leadership between asset class is not constant; it keeps changing. Sometimes a multi-year process. Look at different markets in the same asset class, like US and India, and I've rebased I'm showing it in this common currency, which is dollar. Again, you have a decade, an entire decade where US would outperform India, and the other decade India would outperform the US. And this is multi-year kind of phenomenon. Can it all these things be known in the hindsight? Maybe, but I think it's very difficult. All is what is getting clearer for us based on history is that it is not static. I mean, the leadership changes and the winners change. Look at our market from the asset class perspective, equity, our most loved asset class. And a lot of people get enamored by the finding the multi-baggers, the small cap space, right? Do you know, since the small cap index is there in this country, 16 years, there's no difference. I'm telling you, there's no difference, not even 0.1% CAGR difference in terms of returns that you've got from large caps and that your return you have got from small cap. Absolutely no difference. In long term, everything is same. And this is something which, when you don't look at history, you keep looking at, in the world where we believe that big money can only be made in small cap. I think we miss a point that in the long term, almost everything is same because the derivative is underlying businesses and the economy which is same for all. So this leadership keeps changing, as I have highlighted. And again, the same point that, sometimes small cap for many years. I mean, we know the biggest bull market India has seen between 2003 to 8. It was the small cap which outperformed the large cap. But then after 2010, something changed, and then large cap started to outperform. And this leadership up and down keep changing. And as I said at the beginning of my presentation, um, COVID became the catalyst for the small cap to outperform large cap by 40% over the last 1 year. And that still continues. There's far more resilient small cap despite the second wave as we speak versus the large cap. So this leadership, again, just to note the point that sometimes small cap, sometimes large cap, but it's not constant. With the fixed income also, sometimes if you are you play the long end of the curve, which you buy government securities, you play duration, you make a lot of money. But then many a time that becomes the source of risk, and you have a capital loss. And those times it's better to be in short-term products like liquid funds or short-term funds. And again, the leadership we are talking about is multi-year leadership from one asset class to the other. So I think this is a story which we can keep discussing, but the real story is that change is the only permanent. A lot of people say that we understand cycles, we understand macro, so we'll be able to do that because we have analyzed cycles, and this is what happens that in an early phase and the later phase, these are asset classes which outperform the other. For example, in the phase which is called the expansion phase, risk asset, growth asset, inflation assets like commodity equity, they outperform bond, they outperform cash, right? Uh, Very simple. So if we understand where we are in the cycle, we will do very well. And there's pattern. I'm not saying there's no pattern in terms of business cycle. There are ways to understand where you are in the cycle. But it's easier said than, I have been practicing it for 16 years. And I find it very difficult to rely heavily on macro or top-down views. And I'll give you the reasons for that. Because for macro or top-down investing, you have to be right on hundreds of things. You have to be right on what's happening to, in the geopolitics, in trade wars, in oil cartel, in terms of some emerging market crisis, locally what's happening, rural, the monsoon, this and that, currencies. And now you have new variables in the form of COVID. I mean, effectiveness of the vaccine, how much effective this vaccine is, what percentage of population is vaccinated. So there are countless variables when it comes to framing a good top-down view, and it's not 2 + 2 is not equal to 4 when it comes to macro, because there's so many moving parts and so many interaction relationship of different entities and different factors. And many a times, these while we try to have these view, like I showed you what people were thinking in March 2020, all the macro views have been wrong. And sometimes what happens that, which is also there, is that you don't have a similar cycle in terms of duration, and the context cycle is very different. So sometimes this capex-led cycle, sometimes it's retail balance sheet expansion-led cycle. So no cycles are same, and also the duration of cycles could be very different. Sometimes an up cycle lasts for 10 years, and nowadays the cycles are getting shorter. So it's very difficult to be very sure about the macro investing or top-down investing. And if you focus too much on top down, sometimes you miss out on a great country. Like China had been a great macro story, but pathetic market when it comes to equity returns. And it could be very much possible that China growth rate comes down very sharply and it delivers great equity returns. So I think that is possible. You miss out on a lot of sunrise sectors in a bad market, a lot of industry, because when you focus too much on macro, you miss out on the micro. So what I'm trying to say, that's easier said than done. And what I'm showing it to you here is that you look at the kind of companies we had in India in the last 20 years. Top 5 companies I'm showing it to you. They change. They change and sometimes change dramatically. You had a lot of PSUs, a lot of capital good company, asset heavy companies, and every 5 years you are seeing complete new set of winners and the leaders in terms of sectors and companies. So these are, as you can see, you have RIL has remained the constant, but the ONGCs and other companies have come down. A lot of banks, private banks, IT companies again became very large. Now this is from top 5, companies in the market. But if you look at the sectorally, the whole picture again changes. Financials were nowhere to be seen. Energy was very large in the in the decade of 2000 to 2010. But then, it was just the other way around. Financials became very big, up to 40% of the market, and energy collapsed almost to near single digits. And then you again saw some bit of redistribution in the recent years. So all the point I'm trying to emphasize here is that in the hindsight, a lot of things are clear, but the only constant is that leadership and these things keep changing. Now, if I would have told you that, look, on 1st of January 2020, that look, there is a crisis going on in China, there is some health crisis, you will do great if you don't invest in the largest sector and you don't invest in the largest company. Just avoid these two things. You will outperform the market by 20%. I mean, you would have called me mad at the largest sector, which is 40% of the market, the largest company, which was 10, 11% of the market. If I don't invest in B, I'll still outperform the same index by 20%. And this is exactly what has happened. If I would have avoided the second largest sector, I would have outperformed by 25, 26%. This is all in the hindsight. I'm showing it to you, the leaders, best sectors and worst sectors every year. And the spread is huge. But who can tell me that on what basis these things were successfully and consistently were there to be forecasted? I think it's very difficult. So what I'm trying to emphasize, that mean reversion, sector rotation, asset rotation, this is what is permanent. Everything else looks good in the hindsight. The only rule for me in the market is there is no rule. Investors have to grapple with a lot of decisions making and a lot of choices that they have to make. You have to be in the right asset class. You have to choose the right style. There are value investors. There are growth investors. Some people who only invest in quality companies. Some investors only invest in cyclical and turnaround companies. Some are only believer in large cap. Some are only believer in small cap. All these things. And even in terms of, the big debate, whether technical analysis or momentum analysis is better than fundamental analysis. The reality is that truth is in everything and truth is there in nothing. So, these things are only known in the hindsight. Macro can help, but it's very difficult to practice. And only few people have the temperament to deal with these kind of asset class basis changes and intra-asset, the sectoral and other kind of changes. And that's why, the famous Nobel laureate Neil Bohr had said that forecasting is difficult. especially about the future. And it sounds like a funny statement, but when you think of, what is the track record of forecasting in India, it's abysmal, to be honest. I'm showing it to you what people were thinking about, the EPS of market 2 years down the line. What would be the EPS, and what is the reality? Barring 2003 to 2008, where market consistently surprised the consensus on the upside, where um, most of the time there is Indian forecasters, so forecasters in general suffer from what I call optimism bias. And this is a very interesting thing that forecast usually tells you more about the forecast and less about the future. And this has been the case that there's nothing wrong to be optimistic, but this is a perennial problem that we overestimate things, at least when it comes to equity earning forecasting. And that's where the main point which I want to talk about is that, look, what is the excess of this whole discussion? What is the way out? I think the only way out is having a proper asset allocation plan, and diversification in place. And the grandfather of the modern portfolio theory, Remarkovich, says that diversification is the only free lunch in investing. And I believe in that. That and time and again, every great investor has said that you have to be right in terms of asset allocation. But the thing is, how would you do that allocation? And that's where I want to emphasize the role of systematic investing. And I'm not saying, and I'll explain that why rules and discipline helps us achieve the long-term wealth creation and financial goals, and why we should have that in place all the time. So this is very important. Fancy chart. Now, every one of us who's there in this call knows that, and it's been taught in every class from the beginning, is that investors have to buy at a lower valuation and they have to sell at a higher valuation. It's very easy, sell and done. Sell high, buy low. Very intuitive. Anyone with basic IQ would understand that. But the reality is that very few people are able to do that. So that is a challenge. So investing is as much a behavioral and emotional game as it is analytical or intellectual game. There is a study which has been done in the US by an institute called Dalbar Institute, which says that an average American investor consistently underperform the market. Why does it happen? It happens because whenever there's a volatility, bout of volatility, the rationality goes for a toss. And this is not because you are less intelligent, or sometimes even you have less experience. And that's why probably Warren Buffett said that investing is simple but not easy. What probably he talks about is this emotional bias, the emotional journey that what investors have to go through to achieve their financial goals. And volatility will come from anywhere. COVID is a great example, but even otherwise, there can be any source of volatility. I mean, it's always hidden. Both the positive and negative surprise are hidden, and they hit you when you expect them the least. So this is exactly, I'm showing it to you. There are different ways of volatility which can hit you. Other than that, as an investor, there are other problems as well. So if I'm successful doing value investing, it's very difficult for me to appreciate when the tide turns, and value investing has to, for variety of reasons, maybe because of macro and inflation and growth becoming narrow. If growth investing works, right, it's very difficult for me to cope with that. So the past biases which comes with past success becomes a big challenge for us to unlearn, relearn a lot of things. And now we are dealing with an era where the pace of change is at unprecedented level. There is change happening everywhere in every sector. If you are a fund manager or analyst or investor, you have to take a call on whether to when will the conventional energy become obsolete and alternative energy become the dominant source? When will EV completely disrupt the fleet on the ground that we have of petrol and diesel cars and commercial vehicles? I think in every sector, in banks, the new age banks, the payment gateways versus the conventional bank. I think this is where the challenge lies, that is becoming more and more difficult. And that's where, the best thing to do is to diversify. Why it helps? Because if you look at gold and equity, in the long term, they have given similar return. But look at the correlation between the nothing, zero correlation. If you invest in different markets like international equity and domestic equity, while it's the same asset class, the correlation for the longer term period is 0.2 to 20%. So every asset class, the correlation is either very less or sometimes even negative. And that's where it helps, because long term you will get the similar return. But both of the paths taken by different asset classes are different. When you combine them, the drawdowns, the volatility of the portfolio becomes lesser. The journey to attain the financial goal, to reach that destination, that becomes less lumpy, less bumpy, and actually smoother. So I think that's where we need to be really appreciative of the fact that diversification helps. You can do it in a multiple way. You can do it like a static way, that you decide, look, I know equity is a better asset class, income generating asset class. I love my country. I put money in equity. So I'll put money, and I don't differentiate between large cap, mid cap, small cap. So half of 50% I'll put in Indian equity. Within that, I'll put half money large cap, rest in the broader market. But I'll also put money in international equity. I'll put money in commodities. I'll put money in fixed income. And if you do that, believe me, the variability in the portfolio will materially come down. And you know what is going to work. So it's better to do this thing if you don't believe that there's any other access you have. It may not sound great, but it's effective for someone who does not have time and resources, or who have enough, who don't believe in models, etc. I think this is a very simple, straightforward way of doing diversification. But there are other ways of doing diversification. Some of which I practice for my work and for my living, is that there are rules based investing, and there are a lot of funds in our market also which talks about these balance advantage fund, asset location fund. I find a lot of merit in them, because a lot of things we can't do it on our own. Like, as I said, buy low and sell high. But there is a system which automatically increase your allocation when the valuations are low and reduces your allocation when valuations are high. You don't have to deal with that decision making. It is done by a system. So I think that systematic asset allocation can also help. But then it's not that simple, because it's only valuation cannot be the determinant. You can have multiple factors. And here I'm just highlighting it to you that for example, in one of the fund which I co-manage, we look at the not only valuation for our market where we are, we look at the price trend, the momentum, the technical variables. You have to be open about anything and everything which works. You can't be very straightjacket when it comes to money making, right? So in that case, we look at valuations, yes, but we also look at what is the price trend. We also look at what is happening in the other markets. Like there is a very common understanding that whatever happens in the other market happens in our market also. So I'm just showing it to you here, is that the correlation between our market and the world market, at least the shorter period, is very, very high. And if you look at who's at the driver's seat in our market, barring 2017 to 19, which to my mind was an exception, wherein domestic institutional investor became much bigger than FI in terms of having an impact on the incremental prices of Indian assets. It's the FIs who dictate terms, and where these FIs don't invest very differently in one market to the other. If you look at the sectoral preferences, the size preferences, the style preferences are all same. Look at the valuation between MSCI World Indian market and MSCI EM. It goes in all the same direction. Very, very high correlation, 80-85% correlation in E multiple of emerging market Indian world. Even, as I said, when these investors invest in large cap, you will see in our large caps outperform these, small caps. And the other way around, when they prefer small caps, like the way they have preferred small caps in the last 1 year in global markets, like Russell has outperformed S&P. Same thing has happened in India. So I think at market level, at sectoral level, even at stock level, what happens to Hindalco is very similar to what happens to some other aluminium company. What happens to ArcelorMittal happens to Tata Steel and JSW Steel. What happens to British Tobacco, same thing happens to ITC here, because both are impacted by same ESG concerns. So what I'm trying to say, tracking global market, getting a feel of what's happening elsewhere makes sense. So you combine a lot of things, and you get signals from a lot of those things. And just to give you a very nice, simple tool, which you can use it, you don't have to invest in any fund, but you can use it. I mean, this is a chart I'm showing. It's a fun chart, what I call it. I mean, you invest in large caps when you don't know when to invest in large cap, right? Versus small cap. You invest in large cap when the Sensex market cap as a percentage of India's total market cap becomes 40%. And you become overweight on small caps, right? When this ratio becomes 50%, when Sensex market cap to India's total market cap is more than 50%, you get into these broader market because maybe the large caps have already performed. And this has worked time and again. This is what exactly I'm showing you in this ratio. What I'm trying to tell you is that it's not only one way you can make money, you get signals from everywhere. For example, I can, if I tell you, you can get a great signal from dollar. I told you about the correlation between our market and the global market or US market. And why does it work? Because that is a mother market. US is a mother market. And everything which happens to the world happens because of the movement in dollar. So if you look at the dollar, whenever dollar weakens, and it generally happens for multi-year period, risk assets, emerging market, metals, commodities do well. And whenever dollar has an upcycle, there is a time when the large companies do well and bonds do well, developed markets outperform, tech companies outperform. So and that has been time tested. I'm showing it to you probably the shorter period. So you can get signals from the valuation. You can get signals from technicals like price momentum. You can get signals from dollar. You can also get signal from and this is for example, I'm showing it to for our market. Can you see the correlation between dollar and BSE 500? It's amazing, right? I mean, in fact, dollar sometimes give you an early signal of what is going to happen to your market, but they are highly correlated. The last point, again, another example is that Dr. Copper. Commodities can also give you great indication. They can tell you about the extent of global demand. There are also an asset classes. We can tell you about the liquidity and the ability of the investor or the mood of the investor to put in money. So I think this is again I'm showing it to you the blue line and the orange line. Huge correlation, very high correlation, right? And again, that can also become your tool to asset allocation. So there are ways. The moot point is, and I come to the last few slides. There are ways to do asset allocation through system, to fix weights, or you do it dynamically. Everything has a merit, and everyone is free to choose. Now I'll come to the last two slides. One is on real estate. Again, a lot of people ask whether it's a good time to invest in real estate. Possibly yes. What we have seen internationally, this sector has done surprised everyone. Affordability rates are best on almost 2 decades. Mortgage rates are low. Real interest rates on savings are negative, adjusting for taxes, significantly negative. So whenever these things have happened, and there has been a down cycle, there has been correction, both time and price correction. And before the second wave, there were indication of this cycle turning. Obviously, we need to see what kind of impact the second wave had on the sentiment of the risk real estate side. But if this works, I think it's a good news for the economy also, because it has a good rub-off effect or second order effect on the rest of the economy. So I think real estate, watch out for that, and some diversification directly and indirectly can be done there as well. Last point is related to all our investors in investing life. We only think of India. I think that is not the right thing. I'm not saying India does not have great future, but the thing with the future is that it's uncertain. You don't know who will be the leader. Like in 80s, it used to be Japanese companies ruling the roost, then US, then Chinese, and now US is again back, right? In terms of top 10 companies in the world. And we don't know about in the next 10 years and 20 years, who will be the leaders, which are the profit pools, which we are going to see, the innovations, etc. And if you want to really properly diversify, you have to start looking outside India also, in equities and other asset classes, because that's where you will get the true diversification in your asset allocation. and for your long-term financial needs, I think you have to start looking outside also. And unfortunately, when you look at this data, and this data is not very old, last year's data, late last year, this study was done by IMF, and they say that India is among the worst when it comes to local investor investing outside in outside equity. So this is again one area where all of us have to think, all of us have to start working, because you can't take India's story, any story for granted of entitlement. So just to conclude all of it, I think again, it's the environment is very uncertain. Generally, it is difficult to focus with now COVID and so many monetary and other experiments going on where the valuations are new asset class like Bitcoin, etc. I think there's so much of noise. It's always difficult, but it's definitely very difficult at this point of time. It's not about understanding. It's not about knowledge. It's about emotion. It's about EQ. And I think that's where I think most of us have to really work on. And this comes in in our way to generate long-term wealth. Many a times we make the wrong choices, not because of our intellectual wisdom, but because of the emotional weakness and the sentiments around greed and fear. And if you practice diversification, if you are disciplined, if you go through systematic asset allocation, you probably you get to reach your destination. But my definition of return is that return should not be measured only in terms of this percentage or that percentage. That is important, obviously, but it's a journey. So return should be measured per unit of stress that you do. Same return is giving you a lot of stress is not the great return. So I think if you need to reduce your stress, diversify, follow a disciplined approach, and a diversified portfolio return per unit of stress taken is much higher than otherwise. And last but not the least, I mean, you have to have forecasting humility all the time. And I think this COVID episode gives us a lot of humility, basically, in terms of forecasting and the way we look at life. We should have a lot of gratitude about the uncertainty of life around us. And we should again appreciate the role of luck. I'm sure it has everyone has deep thoughts about it, but I think this appreciation of role of luck in investing is generally in investing in life is generally underappreciated. So hopefully this whole tragic incidents will probably teach us some of the right lessons here. So that's about it. I don't know I will be able to play this, but if any one of you can help me with this, it'll be great. 1 minute video that I have from one of my favorite things.
I'm ready with the video. Can you stop this?
I don't know, Dad. Honestly, sometimes I can't believe I'm actually your son.
Paul, I think it's time I told you something I should have told you a long time ago.
Okay.
The secret ingredient of my secret ingredient soup.
Oh.
Come here. The secret ingredient is nothing.
Huh?
You heard me. Nothing. There is no secret ingredient.
Wait. It's just plain old noodle soup? You don't add some kind of special sauce or something?
Don't have to. To make something special, you just have to believe it's special.
There is no secret ingredient.
Thank you very much. The message was that, there's no secret sauce. Have a disciplined plan, and I'm sure the desired results in terms of wealth creation would follow. So no secret, there's no one formula. Thank you very much.
Thank you so much, Ashutosh. That's a very sort of different conversation that we've had. I mean, generally, you don't get to hear a market practitioner or a fund manager saying that I find it difficult. And you said that a couple of times yourself. So that at least it feels good. We're all human in that sense. It's a difficult time that we're all going through. So I really hope everybody's families are well. Please do take care of your loved ones. And it is a tough time. And hopefully, like Ashutosh was mentioning, in a couple of weeks, we should see the peak of the cases. And if that happens, that'll be really, really amazing. While I'm waiting for a few more questions to sort of line up, I'll just start up, with a couple of questions. So Ashutosh, you mentioned that, take a disciplined approach. US has been the bellwether. But you also mentioned that, before that, China was leading, the US. We had Japan leading as a market. Do you still believe that it is US that we need to look at and follow over the next few years? Or is that sort of changing? Is US giving up its leadership position?
I think what is different now versus the past is that you will have two different supply chains. Different countries will have to align to two different leadership. This whole globalization thing where US was leading and was a buyer, and the supplier was China, and world was divided. The users and the producers. I think that China has become very large, and it has its own, and the whole model has changed. And the more focus has come on the economic profitability side, and the kind of technological advances this even China has made. I think there's no doubt in my mind that they will also produce great companies because in terms of R&D, etc., they are up there. So technology, we call it data as nuance. Technology is what will be the new profit pools in different sectors. Disruptions are everywhere. So I think what I would believe is that it's very difficult to choose. But if I had to choose, I would say two economies which will do very well, are US and China, because both of them will have winners, mega companies, where the profit pool will not be restricted to their own shores, it will be everywhere in the world. And countries have to decide where they have to align with supply chain. It's not going to be one, I'm repeating. But a lot of great companies would come from both the countries. India has also have a great chance if you think about it. There are a lot of good entrepreneurs, a lot of zeal, a lot of innovation. And that actually, that's why you are talking about 100 or unicorns at above $1 billion. You will find some great companies, but I don't know if a lot of these Indian companies would be successful at a mega international scale. But at least from tapping the domestic opportunity, there will be a lot of new winners, which will also come from India.
Excellent. Okay, so got a few questions here. One very interesting question there is, obviously, general trend of some of the questions is going to be "Karne ka kya?" Okay, it's great with whatever you've said,
right.
But at the end of the day, what do we go back with, and what do we really do? So follow some discipline, etc. Yes, but can you? Since you've been talking about sectors, given where things are today, obviously a lot of the indicators that you've spoken about, they will change over a period of time.
Right.
But given where things are today, how do you see some of these things? So, I'll just take some of these questions. So can you rank the following sectors in investment priorities: financials, information technology, and FMCG?
Exactly the way you have asked me.
Okay.
These three,
So,
and from a very long-term perspective.
You still believe
I
in
don't have any
financials?
idea about the short term, but yes, from a longer term perspective, I think financial has a better future than tech, Indian tech, and FMCG, given the price value gap in terms of valuations where they are, and the opportunity at hand, the penetration levels we have already achieved, I think it's a relatively less effective.
Okay, another follow-up question has come related to this. Financials, you mentioned, could still do well, but you showed a slide where the sector weights have changed over a period of time,
right?
And they have also mean reverted, is what you mentioned.
Right.
Financials are a very large sector; they've grown very, very large. Can they continue to remain large and still get larger?
Right. Now, the thing with that is that one of the thing what has happened is that new companies have got listed in India, like over the period. One reason why you have more financial, because 20 years ago you didn't have HDFC Bank, which was listed, or Bajaj Finance, or any insurance companies for that. So you have these companies coming up, and many such companies would come, which are platform companies, and some or the other kind of financial intermediation. So that will be there. But more importantly, I can't believe that India has a great story without private balance sheet, individual balance sheet, household balance sheet expanding material. Who will take the biggest share of the pie is for us to debate. But as a sector, I think this is bound to grow. We are not leveraged outside of the government. We are not leveraged. Corporate leverage is at 17-year low. If you look at the debt equity of Indian companies, even the so-called asset owners are having great cash flows at this point of time. So there's no stress. The balance sheets of banks, you have seen a great NPA cycle of multi-years. That is getting behind us. So to me, I think financials have a great future, and India's story cannot do well. Credit to GDP does not recover to from 50% to 70 to 100%. And if India grows at 10%, and the ratio keep growing, we know companies with good discipline on the capital adequacy side, asset quality side, good liability franchise, and good investments and right investment technology can be great wealth creators.
Excellent. There's a very general question, but very important, I think. So given where our starting valuation is today, so, we doubled in the last 1 year, we're at extremely high levels in the market. Where do you see in the next 5 to 10 years, what will the rate of return one would expect from equity markets?
2-3 points very quickly. So one thing is that I don't think valuation are comparable in two different periods, because the market itself has changed completely. You look at market of today versus market 10 years ago, market 20 years ago, you have a very different kind of company. So earning is one part, but the balance sheet is very different. Quality of earnings are very different. So you have more companies in India which are, the earning volatility is very less. You look at the current Nifty, you'll have banking, which is very different from banking of 10, 15 years ago. You have FMCG, pharma, IT. So you have companies where the cyclicality is much lower, and they would command higher valuation. So valuation per se may not be the right barometer. I'm not saying you can completely discard it, but definitely the current composition would command higher valuation versus the past. Second is that, it's also a function of inflation, any asset class. I would believe that the inflation worries that people have is a short-term one, maybe 1 or 2 years, but in the longer term, the demographics which are weakening, the debt that world has, and when the world matures in terms of the age and balance sheet, etc., and the kind of technology which is very deflationary, right? You'll have inflation coming down. If that happens, naturally the return from all asset classes would only come down. So if and this goes every decade, you can check last 100 decades, like 100 years. So to my mind, inflation would be lower in general in a longer period. So starting point of valuation and the inflation being lower means that the nominal returns could be lower versus what you had last 15, 20. That is my base case. How much lower? Again, we are getting into this crystal gazing kind of thing, which is difficult, but just assume it will be lower. The only thing I would say, returns should be looked in the real terms, right? I showed in one of my slides also. So the purchasing power of your equity investment maybe would grow probably at the same pace as it has grown in the past, but the nominal returns would be lower. Does it sound
Can you highlight, just for the benefit of the listeners, that what has been the real growth in the past for equities, and so if you assume the same in the future?
So it has remained at around 7%, 6 to 7.
So that's the real growth that we should be able to see.
So 6% kind of real growth is possible. Yes, it is possible. But then a nominal growth of 15 would be repeated. It may be lower than that. So you have to start looking returns more. And generally, we don't do that. We all look at the nominal levels of return. But then 10% real, nominal return, 6% real return would be great. That happens. And if I'm right about 4-5%.
Correct. So 10%. So that's a big shift in our mental framework in terms of how we've tended to look at
because you get what kind of money you are getting in fixed deposit. Right? It's always the opportunity cost versus it cannot remain wide for very long.
Correct. And yeah, presume that's the gap that we've already managed to cover. Specific asset classes again. So gold, what do you think the next 1, 5, 10 years?
So I don't understand gold, but only thing I understand about gold is that why it is done well, because it's an insurance of something bad happening. Any policy error, it's wrongly being associated with inflation also, which is not the it's the insurance about the mistakes which our leaders or policymakers do, or the fiat money system that we have. There is an alternative of gold which has come and stolen the thunder of gold in the form of Bitcoins, right? So it's all about, see, when you think of any assets, it's about the confidence of the masses, right? So it has blurred my ability to focus gold, because there is another asset. But one thing I can tell you, uh, we are very susceptible for policy accidents with the kind of experiments, this whole modern monetary theory, the kind of money printing people are doing. Governments are going all, berserk in terms of the deficits, and central banks are supporting them. You can have accidents. I don't find, you need to diversify outside of maybe debt and equity to something which is an insurance in nature, and that you must have. So it could be gold, it could be something else. I don't understand Bitcoin. If you understand it, someone else.
That is one of the questions also, that should we be looking at right time to invest in alternatives, including crypto? You said you don't understand it, but for the people who then do, at least you're saying the diversification.
The only thing is, when you're investing in crypto, you're fighting against the government. So you should be very against the government. You should be very sure that governments will lose. And I'm not saying they don't lose, but every government on this planet have to lose. Because they are also talking about their own digital. They understand. They are also thinking about their business continuity planning. So they want to come up with their versions of these electronic tokens. But to be honest, it's such a no history, nothing, so can't tell. But if 2-3% you invest, you can invest in this thing like an insurance. You pay 1% premium of your net worth for the that's how insurance works. So you think Bitcoin and gold like an insurance rather than as a.
Got it. Okay, that's an interesting way of looking at it. Related to that, since we're talking about a currency, where do you see rupee in the next, again, 1 year, 5 years? We've tended to depreciate typically against the dollar. Should we have some accelerated depreciation or otherwise?
I think so. What happens with rupee? You have periods of stability, and suddenly 1 year you have 20% depreciation. This is a pattern. Again, when we think of data, we are talking about only 30-40 years of data. Not statistically significant, for most of Indian assets, right? But the way I look at it, the kind of, it's not, you should think of rupee versus lot of currency, not only dollar, because one is dollar, right? It has its own challenges. It's importing a lot. It's again, the debt levels are high. Someday it can become a challenge if China becomes big and in terms of trade and acceptability of Chinese currency become more prominent. It's already happening. So if you look at the global forex reserve, for the first time in decades, US treasuries are less than 60% in global forex reserve. They used to be 70%, and they are not now fallen below 60. So short term aside, I think long term, I find it very difficult for dollar to do it, to be honest, because it has done. I mean, you have seen the leadership in currencies also changes, the leadership in trade, etc., and which I think is moving towards east, maybe China, some emerging markets. So that is one area. So that's why I said, you have to look against which currency. Ultimately, it's a ratio. So maybe not too much of depreciation in very long term against dollar, but may depreciate a lot against some other currencies, like say, for example, yuan. It is possible, because they are becoming more consumer oriented. There's no rather than export oriented. They are importers than exporters. So they would prefer to have strong currency, and why not? I mean, They're just warming up. They are getting now included in MSCI or global bond indices. This very early days, they will get attract a lot of the kind of growth they are going to show for decades. So you can't look at one care, you have to look at multi-care. But at current state, I can say with the forex reserves we have, I don't expect any crisis of sort. Whatever depreciation, appreciation happen will be very measured.
Interesting. One asset class that you spoke about, which I think has given some degree of hope to a lot of people. We've been seeing this very sort of depressed market on the real estate side, which has changed in the last 8 months, at least in terms of velocity of transactions. But the question is, affordability is still not there in metros. So, you have a few big deals happen during the COVID era. But it seems from the person who was asking this question that the trend still seems to be down. Would you differentiate between real estate in metros specifically such as Mumbai and some of the other metros versus other parts of Bharat? Or do you think real estate as a whole can probably turn around? And given your view on inflation, how does that sort of pan out?
So it's a tough one because, it's a very micro market thing, first of all. And labor market is not great. Few things are working in its favor is that, you have pathetic returns from FDs. Your mortgage rates are low. You have some consolidation. COVID has kind of, I don't know structurally, but at least for the time being, have increased the propensity to buy your own house because this is where you live 24/7 now. There will be more work from home. I think that is a more permanent change. And in fact, you need your house. I think that will be there. I think what could probably happen is that you have an uptrend starting, downtrend ending for sure. But the uptrend will have not, it's not going to be as smooth as we saw in the previous cycle where there was, multi-year of 12 years of uptrend all over the country. It will have its own short circuits every now and then, and it will be, weaker uptrend. But it looks like, and what happens, with these asset classes? If asset class start to do well, you get more interest in that.
Okay.
So it feeds on itself, equity or real estate or gold or Bitcoin. So next 6 months to 12 months are very important. If it sustains, even to some extent, then it will feed upon itself. And that's where I think the second COVID wave have kind of blurred the whole picture. But before that, I can tell you, it's not restricted to metro. Across cities, across state, despite stamp duty cuts, the stamp duty collection was higher. That means huge transactions were happening, visible in paints data or cement data, right? There were definite, signs. How much the confidence this second wave has impacted, and I think this is very important for everything, not only real estate. That it may be a 5, 6, 8 weeks phenomenon, but the kind of fear people have got because of the second wave is unprecedented. So the pent-up demand, which you saw after first wave, could be very different this time, because the kind of fear the around you and everyone, right, that human tragedy we have seen, is very different from the first time. People are far more fearful and they may retrench, right? So that we need to see for all kind of spending, including the real estate.
That's a good point, yeah, because first wave, we had a very severe lockdown. Most people were actually questioning whether we really needed it or not, because most of us came out unscathed from that first phase, which second wave has been a little different. Another question here that I'm looking at is, high P companies and companies which have no profitability, etc. So, typical startups and your fancier names. How do you see that?
It's a challenge, As a fund house also, we are struggling because that requires a very different mindset, private equity kind of mindset. That these are the growth companies which will become value over time, like after 5 years or 7 years. And this is how the capital market has played out over the last a decade or so, right? Like look at Amazon or these kind of companies. They were already always a very high P company, right? In India, you have a lot of these examples. So yes, obviously, the price value gap is difficult to understand, but you can't ignore companies just because they're expensive. You need to have some leap of faith because I can give you one data point. I have done this exercise. 2015, whatever the index was, the earnings of the companies for a lot of value stocks, actually the EPS after 5 years was lower. And for a lot of the expensive companies, EPS went up significantly. So the PE of this expensive company after 5 years was actually had come down to level of the value companies, and in many cases was actually lower than erstwhile value companies. So when it's very difficult, few investors get it, and many don't. But I think this challenge is there with so many unicorns getting listed. I think some leap of faith will have to be there. There will be some accidents in between, but I think this is where the new phase of IPOs and investing will be there, where uh, you have to shun the traditional way of looking at companies from multiple perspective. That valuation multiple is not value. Value is there in the future, in the residual value. So it's not a simple answer. I don't have the simple answer, but I think everyone will have to deal with it on its own.
So simply looking at P may not really work. Interesting. So talking about value, there's a question here about PSU banks and PSU companies in general. And they have done exceptionally well. Large caps like SBI have doubled, etc. What is your view on public sector banks, public sector companies in general?
I think a lot depends on, they have not been the great owners, right? I mean, private sector has the skin in the game and they innovate and, the best practice. So obviously, there is this valuation argument which is there, definitely, which is there. But from a very long-term perspective, I have not seen public sector in any market coming back and gaining leadership. That is there. So can there be periods of multi-quarter where some mean reversion valuation happen? It is possible, but then don't paint all KSU companies in one bucket. Right? The biggest lender in the country is doing phenomenal job in terms of having great subsidiaries, right? And investing a lot in technological capabilities. So it can surprise. There could be some great tech company which can come from the public sector side. IRCTC is one example. Right? So you don't paint everything with the same brush, but at the same time, don't get really overly excited, because I have not seen whatever little history I have seen in global market that once the public sector loses the market share, they regains that in the respective sectors. And the new age sectors we are talking about, public sector unfortunately is not there, except in defense, which is is a kind of closed kind of sectors, and you may have some winners there, but in general, don't invest because it's a public sector company or not. I mean that should not be the criteria. That is the first criteria invest in the company, but I won't be too overly excited on the theme as such.
Got it. There's a question around, you mentioned that, we should invest in diversify the portfolio, and a certain portion could be in commodities. And, while gold as a commodity is easy for Indians to understand where to invest, and there are quite a few options. You spoke about different commodities also. So how can an Indian investor invest in commodities in their portfolio? Any thoughts on that?
One way to play is through the stocks, because underlying businesses for these metal companies, tough commodity companies, or chemical companies, or in all kinds of commodities. You can invest in those companies. Other than that, I think there is pretty matured, I would say, commodity market. If you believe in that, that's possible. There are unfortunately, when it comes to products, it's only gold and silver ETFs that you have. Not on the industrial commodity side. But outside India, there are a lot of ETFs where you can just buy these ETFs, and these commodity ETFs can make you money, and obviously can give you rupee hedge also, if that's possible. But then the best thing to play commodities, if you want to take advantage of operating leverage also, is through buying these commodity companies rather than directly buying these commodity as an asset class.
That's an interesting thought. So, I mean, related to, how to sort of invest, there was a question about investing in the US or in international equities. So are there ETFs in India? So I believe there are ETFs in India,
There
which
are
somebody could
ETFs.
probably look up and
Yeah,
look
there
at.
are.
And I think,
There are
like you
feeder
mentioned,
funds. There are feeder funds. For example, our organization have feeder funds for Japan, for Taiwan. There we have filed. There is one for US, and I'm sure there would be similar feeder funds and other fund houses. There are alternatives you can look from. So
so I
actively
think that should
managed
be
fund,
easy
feeder
to.
funds, or the ETFs. Yes, if there.
Got it. So there is, finally, it again comes back to, where should one really put their money and how should the one look at it? So one question relating to that is, given, you're saying that nominal rates are going to be low from equity, while real returns may be higher, would you suggest sticking with debt for a couple of years? And I believe that this question probably comes from, unless I'm getting it wrong from whoever's asked this, because in the sort of unregulated market or not, the prime lending market, there seems to be some reasonably elevated nominal levels of interest that you're able to earn. So the question is, do you suggest sticking with debt? And break that question into two parts, if you can. One is obviously taking some credit exposure. So today, we've had our accidents in the last 2-3 years after the IL&FS crisis. Is credit okay to take exposure to? And second is, where do you see any exposure to gilts? And your fund house has a long-term gilt fund.
Yeah.
Something like that, does it sort of make sense?
So frankly, again, not an expert on the fixed income side, but I'll still give you my view. On the gilt side, I think there is a lot of supply pressure. RBI is doing their best, but next delta in terms of rate action, whenever it happens, maybe a long time from now, probably could be another rate, the rate hike, not rate cut. Secondly, our country is, particularly the RBI, is running on a treadmill whose stop button is broken. So if they don't support, so we are in that trap that government will have to keep borrowing. There are reasons which are beyond this discussion in terms of wealth income divide and so on and so on. They have to support a lot of constituencies, and they will need a lot of money, and they will need a lot of money, which won't come easily from banks and insurance companies or FIs. I think the RBI will have to play a very significant. That uncertainty is what is getting reflected in the term premium, the short-term rate and long point of time. What has happened on the credit side is that the spread have already narrowed a lot, unfortunately. It happened very fast. Market doesn't give you, it's not lazy entity, right? I mean, that's why market is supreme. So that some bit of compression has happened. But if the economy recovers, obviously more compression is possible versus spread compression is possible. But I know a very large cement company raised 10-year money at 7%. Ultimately, it's a cyclical company. So the point is they are borrowing at the same rate as state of Maharashtra. So I think it's not as attractive. If you think of 2 years, if someone is worried about 3-6 months of valuation, I can understand get into fixed income or they were said. But 2-3 years, I would say equity may still give you better. At least internationally, I can tell you, fixed income is actually fixed income but unlimited risk, right? And but may not be in India, but if a global interest rate go up, there is that upside pressure also. So my view would be that if 2-3 years, if you can stomach the volatility, it's better to be in equities versus fixed income from 2-3 years.
But still diversify, of course.
There will be volatility. There will be phases where equity will underperform fixed income, but you'll still be better off from a medium-term perspective in equities.
Excellent. Your thoughts on, it's a very specific question, on the largest insurer in the country coming for an IPO. I don't know if you're permitted to talk about that.
No, I'm not. But all I can say, hopefully, it becomes successful. The privatization becoming successful from a macro perspective is very important. That's where banks will get breathing space and interest rate pressure would ease. So let's hope that privatization plan get successful.
Yes. There's a specific question again, but sector related. So large cap IT versus small cap IT and mid cap IT. I mean, do you have any?
Get winners. You have winners
in both sides.
Yeah, because we call them IT, we call them pharma, but their niches are different. The markets are different. Customer they are catering to, the technology they are catering to are different. You have winners everywhere.
So, so the question taking a cue from the finance minister, is it right to predict that a repeat of 2021 budget would happen, and should go out all for infra, materials, green energy, healthcare stocks? Some of these themes have probably played out. Do you think that continues?
So there is definitely more focus on government capex, no doubt about it. Only problem on what uncertainty which has come is that when this budget was presented, at that point of time there was no sign of COVID. Second wave was not ending. What was also not anticipated is this kind of commodity price rally or inflation pressure. So, what is possible is that, and hopefully this COVID wave comes down. If it gets delayed, right? This peak happens late and the recovery takes time. There will be some pressure on government finances. And today the GST data has been great for March, but I'm just saying even from next fiscal year perspective, and when that kind of pressure comes and they are in some kind of fiscal consolidation path, they may lose the space which they had kept available for infra spending. So that may get delayed. So, in some way, infra spending would be a function of how fast we work on this. Because that otherwise that money, resources will be lesser because taxes will be lesser, and some of the resources might have to be diverted to, alleviate the pain of, the COVID-related pain to trouble. So that's what my belief is. So, and some of it is also already recognized. So, I would keep saying this thing: you diversify, and a lot of sectors that we look at don't have great price value gaps. A lot of things are priced perfectly for different reasons. So one needs to be mindful that like I'll give you an example: top 10 companies P in Nifty and next 40 companies P on FY23 basis is exactly the same.
Oh wow!
So now you can't say that cyclical recovery is happening, so you get into the smaller company. Some of that has played out, and the expectation is already there in terms of earnings. So valuations are same. So I would say I would be looking at this environment and see it through rather than taking very definite calls till I have some clarity on the second wave. And that does not mean I get into safer assets, safer sector. It's just that the deviations which I would like to take would be lower than anything.
Got it. That's interesting. There are some specific questions which I think I could just probably answer. So there's a question on how to invest in other countries, commodities and equities. I think there is the LRS route that a lot of people can take, up to $250,000 per individual. We can actually take out of the country. There are platforms available in India. Some of the platforms run by Indians to invest abroad, and it's very, very easy to sort of do that now. And the question on ETFs versus indices, what is better to invest? Indices you cannot invest in directly, so you'll have to invest through an ETF if you want to take that exposure, and you'll have to do that research in terms of which ETF makes more sense. I think I'm sort of running out of questions and also time. I'm sort of mindful of that. There is a Mumbai versus Chennai cricket match to watch, and I think everybody will be interested in that on Saturday evening. There are some comments which I really want to read out. There's one comment which is saying that, thank you so much. We're enlightened to know that no one can predict the future. And that I think is very, very comforting. And really appreciate the honest and transparent explanations that you've provided. And one thing was, markets are high, shall we spend money for needs and wants? And I think that just propels the economy, right?
You will be helping others.
You'll be helping others. Thank you so much, Ashutosh. Really appreciate your comments. Okay, wait, there is another question here. I will take that. How practical is the global production moving to India gradually? Is India as a country gradually opening, gearing up to grab the opportunity for production actually practically moving here? What is it that you're seeing?
You know what's happening. I mean, if you listen to the corporate leaders and the interest people have, it may surprise. I think that is our biggest hope and biggest bet. In government, in this crisis period, they have opened up this PLI schemes. Good thing is that they're in all sunrise sector, and world is looking for alternative to China. That's why I said is one important thing, and that's where I think it may not be only the Indian corporates, but India can become production base for global companies, and a lot of FDI can come. So I think that possibility is there. We don't have the infrastructure bottlenecks which used to have. The taxation is much lower and easier. And I think government understands that, on their own, they can't generate jobs. So they will do whatever it takes. They were doing the right things, but this crisis is such that, some of these things are taken back. We should all be very hopeful about some of the supply chains coming to India. And I think government will do everything for it.
Excellent. Thank you so much. And thank you, Ashutosh, for taking the time out on a Saturday evening. Thank you all for joining in. Thank you to the team at Boomerang for organizing the back-end technology for this. Have a good evening, and please take care during the second phase. We still need to be very, very mindful of how we conduct ourselves. Thank you so much.
Thank you.